Over the next hour, you're going to go from being a property investment beginner to not only starting your journey to becoming a property investment expert, but you'll also have these 5 tools so you can actually start investing. But to do that, you need to learn these 5 lessons, which are the same things I've learned over the last 6 years of hosting New Zealand's #1 property podcast and helping over 2,000 Kiwis invest with my team of 17 financial advisors. And if you make it to the end of this video, you're going to get all of these 5 powerful tools for free. Now, the first thing you need to figure out is if you can afford an investment property. And the thing that surprises Kiwi investors again and again is that most property investors I meet buy properties with no cash down. And that's where you might think, well, how do you buy an investment property with no cash? Well, that's when you use the no cash needed method. Now, when I first started investing, I saved my deposit. That's the slow way of doing it. But if you have owned your own home for a while, you might already have a deposit, you just don't know it yet. Let me explain. Imagine you've got a house worth $1 million and the mortgage you've paid it down to $300K now. Well, the difference between the $1 million value of your home and the $300K mortgage, that is your equity. And in this case, you'd have $700,000 worth of equity within that property. Now, you can use some of that equity as the deposit to buy an investment property. Now, you can't take out all 700 grand of that equity because the bank wants a buffer to protect themselves. Now, for an owner-occupied property though, you can borrow a maximum of 80% of the value against that property. Now, $1 million property, can borrow 80% against it. You can borrow up to $800,000 against this property in this case. That keeps 20% as a buffer for the bank. Well, your usable equity, the amount you can borrow as the deposit for an investment property, is the difference between that maximum amount you can borrow, $800,000, and your current debt, in this case, 300 grand. So in this example, your usable equity is $500,000. That's the maximum amount you could borrow against your house to go and use that as the deposit for investment properties. Now, in practice, you could use that 500K for anything. You could borrow 100 grand and go and buy a boat. You could borrow 6 grand and go and buy an e-bike. But here's the magic when it comes to property investment. You could borrow $120,000 against this house as the deposit for an investment property. You take that out to a second bank, that's your deposit, and the new bank will lend you up to 80% on the next rental property you want to buy. In this example, let's call it $480,000. So in this case, you've borrowed 120 grand from your first bank against your main house. You've borrowed 480 grand from a new bank against this investment property you want to buy. So in total, you've borrowed $600,000 to buy your investment property, but you've done it without any cash down. You've borrowed all of the money to do it. That's why it's called the no cash needed method. Now, the really important thing here though, is we're talking about a $600,000 asset without actually having to save up a deposit because you've already got this wealth locked up in your house that you just haven't been using. But if it was really this simple, everybody would be doing it. You just need to know that it's not just the deposit the bank looks at before they approve your mortgage, because before the bank approves that mortgage for you to buy your next investment property, you have to be able to afford not only the debt you've got at the moment, your current mortgage and any credit cards you've got, but also the new debt against this investment property after your rental income is taken into account. And the banks don't just look at if the rent for your new investment is going to cover the mortgage. The calculations are a bit more complicated than that. They'll see if you could afford the mortgage as if the interest rate was 7%, not the 5% you might actually end up paying. Or they might say, well, what if you don't have a tenant for a while and you don't get all of the rent? Because all of these calculations are honestly quite complicated, you can actually just use this free calculator that asks you 9 simple questions, then estimates how much you can afford to spend on an investment property. And the link for this and all of the tools I mentioned today are down in the description. Let me show you how it works. And the tool works by asking, do you have a partner? Let's say you are investing with a partner, you've got one child at the moment, and you both have a car. And let's say that you earn $100,000 per year before tax and your partner earns $60,000 a year. And we do this because we need to understand both your income and also the expenses of having cars and kids. Now, let's say you don't have any savings at the moment, But you do own your own house, and let's say that's worth $800,000 and you've got a $320,000 mortgage, and you're currently just using this as your owner-occupied home, a home you live in. Now, what you can do is type in some details and see your investment ready score, which in this case is 100%, because you might be able to spend, call it $886,000. Now, this isn't a pre-approval. It's not a guarantee that you absolutely can borrow the money to invest, but it is a quick guide, and you can even see some of the types of properties you might be able to afford. Now you know if you can afford an investment property, there are 3 major decisions you need to make before you start looking at properties, because right now there are over 40,000 properties currently listed on sites like TradeMe, OneRoof, and realestate.co.nz. But how many could you realistically look at as an investment? Maybe 100 before you end up buying one property, but you can't look at all 40,000, right? So you need a way to sift through these 40,000 property listings to look at only the ones that are potentially good investments. And we do this by setting our buying criteria and making these 3 key decisions. And the first is your strategy. Are you going to buy and hold for the long term, or are you going to flip properties? Now, with the buy and hold, you buy a property, you rent it out, you wait for the market to naturally go up over time, and this is about building wealth over the long term. Now, let's say you buy a $500,000 property today, you rent it out for $500 a week. The minimum deposit that you could use to buy that property is going to be about $100,000. You might use cash, or you might use the no cash needed method to fund that $100,000. Now, fast forward 15 years. Let's say that that property's doubled in value. That means that's gone up on average by roughly 5% per year. That property that you bought for 500 grand is now worth $1 million. So you've made $500,000. That's been the increase on your property that you purchased. And that's been based on your $100,000. So you put in $100K, you got out that deposit plus an extra $500,000. You've basically 6 times your money. Now, the pros of the buy and hold strategy is it's really easy. Most investors have made money this way. There are lots of properties you could potentially choose from. It can be pretty passive. You don't need to do big renovations on this property if you don't want to, but there are some cons too. You're often relying on the property market going up in value for you to earn that return. And while property prices tend to go up over the long term, you don't know when you're going to go through that appreciation phase where property prices actually do go up. You can't guarantee that house prices are going to go up in the short term, but the real Achilles heel of the buy and hold is that over time, your property is going to need some big long-term maintenance, whether it's a new roof or replacing the hot water cylinder. You're going to need to budget for some of those bigger costs, and most investors don't. And that's why some Kiwis decide to use the flipping strategy. Now, this is where you buy a property, you renovate it, and you sell it as quickly as possible. So rather than building your wealth for the long term, if you use the flipping strategy, it's mainly about generating an income today. So let's say we take that same $500,000 property. But this time, if we're going to flip it, we're going to need a bigger 30% deposit, not a 20% deposit. And that's because you're going to need to buy an existing property which needs that bigger deposit. We'll talk about that a little more in a moment. So in this case, rather than a $100,000 deposit, you're going to need an extra $50K. Plus, we're going to need some money for the renovations. Now, if we're going to do this properly, I'd suggest around a $100,000 budget in this example. So all in, we're going to need $250K. $150K for the deposit, extra $100K for those renovations, just to get started. And that can come from cash, or again, you might use the no cash needed method for this if you've got enough usable equity. Now, 6 months later, after we've done the renovations, the property is now worth not $500,000 anymore that we bought it for. It's now worth $700K because your purchase price was $500,000, the renovation cost you $100K, you invested $600K in total, you've made $100,000 from the property going up in value. So your return was a $100,000 profit based on the $250,000 that you invested. That is a 40% return over 6 months. Now, that's a really good return. And the good thing about flipping is you make your money pretty immediately. You're in and out in 6 months if you can manage it. You can also replace your income doing this because doing 2 or 3 flips a year, that could make an awesome income for a lot of people. And best of all, you don't need to wait 15 years or more for the investment to pay off. But there are some cons too. First up, you've got a one-off profit. Like if you sell that property and it keeps going up in value, you don't get any of that increase anymore. Someone else gets those gains. And remember, you only get the long-term benefit of property prices going up if you hold on to that property for the long term. And you don't do that with flip properties. It's also a very active strategy that you need to keep repeating, right? It's not a one and done like the buy and hold strategy. If you've got to keep making money from flipping, you've got to actively keep doing it every year. And there's a bit more risk to it because you need to find a buyer really, really quickly, because once you finish up those renovations, you're still paying the mortgage to the bank. And that's the real Achilles heel of flipping. If you can't sell that property quickly, you're still paying the mortgage on an empty property. That can erode your turns. And this decision really matters because it impacts the sort of property that you're going to look for. So if you do the buy and hold strategy, you can and probably should look at properties anywhere in the country, ideally looking for properties that don't need much ongoing maintenance. Whereas if you are going to flip properties, you often need to look for a property that is in need of a bit of a do-up and is within driving distance from where you live, so you can actually do the work yourself and maximize your profits. So your first decision could take those 40,000 properties that are currently listed online and cut it down by maybe 75%. And that takes us to decision number 2, which is whether you want a growth property or a yield property. Now, growth properties tend to go up in value faster, but they don't have as good cash flow. They're typically maybe a house or a townhouse in a good growth area, and they are generally a better fit for younger investors under 55 who want to grow their wealth. A yield property, on the other hand, it doesn't go up in value as fast, but it gets a really good rental return. These might be apartments or multi-income properties, maybe even boarding houses, and these work well if your goal is to stop working and just live off the rental income today. So let's say you could either buy a $750,000 growth property or the same priced yield property. Now, if you go for the growth property, it might cost you $150 a week to own in the first year. That's if you use the no cash needed method. But if it goes up in value by 5% on average a year, after 15 years, it would have, with these numbers, increased in value by $809,000. And over those 15 years, you might have needed to top up that property in total by $12,500. So your return might be just under $800,000. Whereas with the yield property, it might not cost you anything to own in the first year. The rent might cover all of the costs, even if you use the no cash needed method. And it still might go up in value. In this case, let's call it 3.5% on average a year. And after 15 years, the property could have gone up in value by just over $500,000, and you might have earned about $90,000 in cash flow. So all up, your return is around that $600,000 mark. Now, that's great, but in this example, the growth property makes about a third more money. Now, I was at the gym recently, if you can believe that, and a 24-year-old guy recognized me from one of our webinars, and he said, should I buy a growth or a yield property? And this is one of the most common questions I get asked. And I said to him, well, typically somebody who's 24 years old, that long-term growth is going to be so much more valuable to them than the extra $50 a week you might get in your bank account if you go with the yield property. But if you're 62 with $1 million in the bank, a yield property might make more sense because you care more about earning that long-term rental return. And again, this decision matters because if you buy a growth property, you're probably going to start looking for a house or a townhouse in a good growth area, which you'll learn how to spot in a moment. Whereas if you want a yield property, you're going to be searching for an apartment, a multi-income property, a boarding house, something similar. So once you make your decision about growth versus yield, you might be able to knock out another 20% of online listings. And that takes us to the third major decision you need to make, which is whether you're going to invest in a new build or an existing property. Now, new builds work for people who want to be as hands-off as possible. They've got busy day jobs, probably kids, a life outside of property investment, and they want a low-effort property with few maintenance surprises. And there are a couple of big benefits if you decide to buy something that has just been built. You only need that 20% deposit rather than a 30% for existing properties. That means you don't need as much money to get started investing in property. And as you'll see in a few minutes, that lower deposit can lead to a higher return on investment. And you often have much lower maintenance costs because everything's brand new. But there are some considerations as well. You can't renovate a new build to increase its value. It's already brand new. What are you going to renovate? And new builds are typically smaller for the price you pay, both in terms of the land and the size of the house. But what about existing properties? Well, these tend to work really well for people with renovation skills or maybe contacts in the building industry, because that way you can add value through renovations. You can do up that property and you'll typically get a slightly higher gross yield or rental return. And part of that is because you usually get a bigger property and bigger section for the price you pay. But you also need to keep in mind that you're going to need about 50% more money to get started, because you need that 30% deposit, not a 20% deposit, and you're also going to have to pay for any of those renovation costs. On top of that, remember that older properties often have higher and more unexpected maintenance costs because the hot water cylinder could burst or it might need a new roof in a few years. Now, neither new builds or existing are exactly right or wrong, but if you're a builder, maybe a plumber, an electrician with some contacts, you might prefer to buy existing properties and use those skills. Whereas if you've got a life outside of property investment and this is just a means to building wealth, a new build could be the right fit for you. And again, the reason you want to make all of these three main decisions is to create that buying criteria, because you can't look at all 40,000 properties online, but you can immediately eliminate tens of thousands of those properties based on which are going to fit your strategy and which decisions you make. For example, if you decide you want to use the buy and hold strategy, you want a growth property, you want a new build, you have just narrowed down your search dramatically because you're only looking at properties that fit that criteria. And often I see investors struggle to make these three decisions because each decision has pros and it has cons, and often the people, I meet at least, want the best of both worlds. So to help you make these decisions, you can take this free assessment to figure out which of these decisions are right for you: growth or yield, new build versus existing, buy and hold versus flipping, based on your personal situation. The link is in the description below, and after just 5 minutes, you'll get a recommendation about what could be the right decision for you. Now that you know the type of property that you're looking for, the next question is, well, where should you actually buy? Now, what you don't want to do is look at the area that you personally live in and think, I live here, there are properties here, I'll just buy one down the road, because your area might not be a good place to invest in right now. Instead, what you want to do is look at the data, like whether house prices in your area are a bit overvalued or undervalued right now, and how good the rental returns are. Because you might find that where you live actually is a great place to invest, or you might find that there are better investment locations somewhere else in the country. But what data do you look at, and where do you get it from, and how do you turn data into a really good investment decision? Well, if I went back the clock 6, 7, 8 years when I was just starting out investing, it was really hard to get good data about which areas are good or potentially good areas to invest right now and which ones aren't so good. And that is the exact reason why over the last 7 years I've spent tens of thousands of dollars on data and built you guys a free tool where you can actually get the right data that you want for over 1,000 suburbs in New Zealand. And it's all tied up in this free tool called Area Analyzer. Now, here's how to use it to decide where to invest in next. One of the most important things to look at is where an area is within its property cycle. So house prices tend to go up everywhere over the long term. But there are plenty of times where house prices might go down in one area, and then there might be this massive boom phase where property prices skyrocket. Now, in an ideal world, you want to buy at the times where it's about to go through that big phase of exponential growth. But how do you spot that before it happens? Well, that's where you might use the overvalued, undervalued model. This is where you see a region or an area and compare how it's doing versus its long-term average against the rest of New Zealand. Now that might all sound a bit complicated, so let me show you how it really works. So if Invercargill house prices are usually 60% cheaper than the average house price in New Zealand, but right now it's only 40% cheaper than that average, well, Invercargill house prices, they're still cheaper than the average in New Zealand, but they are overvalued because they're more expensive than you'd expect them to be. You'd usually think they were cheaper. Compare that to Christchurch though. House prices there are currently undervalued by about 5 to 6%. That means it's cheaper now to buy a house in Christchurch than what we might expect to be if all property markets went up at the same rate. Because house prices there look a bit cheap, you might expect them to go up a bit faster in the future compared to other areas. So it's one signal that it could be a good time to buy there. Now, if we look at Lower Hutt, for example, it's slightly undervalued. but it's probably not as undervalued as I'd personally like to see. There's probably still going to be a period where house prices there are relatively flat. Now compare that to after the GFC, the global financial crisis, when Lower Hutt was 20% undervalued. Then the market went crazy in the 5 years after that. Now, why does this even matter? Because let's say you own an investment property for 8 years and the house value doesn't go up at all. That gets pretty depressing, especially if you're topping up that property every week because the rent doesn't cover all of the costs of owning the property. So you don't see an immediate return on your investment. Eventually, maybe in year 7, your partner's telling you to sell that property because it hasn't gone up in value. You sell the property to someone else, they buy it, and then they go through that next 5-year phase of house prices going up. Well, that sucks to see. So what we want to do is look for areas that are undervalued to get as much growth in the short term as you reasonably can get, because if that happens, it gives you more confidence to keep investing. Now, once you find an undervalued area, you still have to decide where to invest within that region. After all, a big city like Dunedin has lots of different suburbs you can invest in. Now, typically, investors want an area that has a good mix of capital growth, the house price going up, and yield, which is the rental return that you get on your house. And that's where you can use these two maps within Area Analyzer. First, we've got the capital growth map. This shows where property prices have increased the fastest. And then we've got the yield map, which shows where areas have the highest rental return. For example, if we look at the Wellington region, Wainuiomata, that's had some really strong capital growth, 7% I think between January 2000 and June 2025. Caddons Creek in Porirua City, that's also had really good capital growth. But if we look at Te Aro in central Wellington City, that's had much lower capital growth. Now, history doesn't repeat itself exactly, but it often does rhyme. So just because house prices in one suburb have gone up really fast in the past, that doesn't guarantee it's going to happen again. But this data helps you ask, well, what factors led to house prices going up really quickly? And could those factors repeat? Well, even if you're focusing on a growth strategy, you still need to think about yield. It's still important. And you need to make sure your property has good enough cash flow that you actually can hold on to it for 15 to 20 years so you can get that long-term wealth building. If you can't afford to hold a property, well, you're not going to get the house price growth because you're going to have to sell that property so soon. So what you can do is look for a suburb with good growth and then see if it also has a decent enough rental yield. Now, a few I've seen that fit the bill are places like Spraddon and Christchurch or Mangere Bridge in Auckland. And you can access Area Analyzer completely free. The link is down in the description. Type in any area in New Zealand and start analysing the data yourself. But once you find the right area, you still need to look at houses and tell which one is the right one to invest in. And you don't just want to decide which house to invest in based on what it looks like. As an investor, you've got to run the numbers because that's how you'll know which property really could be the better investment. A lot of people tell you to run the numbers, but then they don't show you how to do it and how to tell if those numbers are good or bad, which is why you need to learn how to run the numbers like a real investor. Most people start with gross yield, which is where you take the weekly rent, you multiply it by 52, that gives you your annual rent, divide that by the property's value and multiply it by 100. Now that gives you the gross yield. So let's say you have a property that rents for $500 a week. Multiply that by 52, cool, annual rent of $26,000 a year, divide that by the $600,000 purchase price, multiply it by 100, we've got a 4.3% gross yield. Now this is an okay way to start looking at properties, but it's too basic to tell you if a property is a good or a bad investment because it doesn't take into account the costs of owning a property, like if it's got a really high body corporate cost or what you're specifically looking for. Is it a growth or a yield property? Or even things like whether you're renovating the property to increase its value. I think of gross yield as your heartbeat. It gives you a quick pulse, but it doesn't tell you if that property is fit or flabby. Now, after searching for several years, I found a better alternative in my mind, and it's called return on investment. And the reason I like to measure properties based on the return on investment is there are 4 potential ways you can make money out of property. Capital growth, your property going up in value. Instant equity, you renovate the property, you increase its value. Cash flow, whether it makes you money each week or month, and then paying down debt over time. Gross yield only looks at part of cash flow, but only looks at the rent, whereas return on investment looks at all 4 of those ways to make money. On top of that, you've got 2 types of investments when you purchase an investment property. It'll be your deposit even if you borrowed it from the bank using the no cash needed method, and then any top-ups that you've got to make, which is when the rent doesn't cover all of the costs of the property. And what you want to know is, how do all of those returns compare to all of those investments that you're putting in? Now, return on investment sounds great in theory, but especially in the past, running the calculation has been extremely difficult. In fact, you would have had to book in a meeting with one of my financial advisors at Opes Partners or download a spreadsheet to run the calculations. But now it's really easy. You can run these numbers for any property in the world using a free app called Opes Plus. Let me show you how it works. So you might have been looking at a property on TradeMe, and I found this one in Eltham in South Taranaki, not too far away from where I grew up. And you're thinking, okay, it's a relatively cheap property, but is it a good investment? So we can copy that link, head into Opes Plus and add a new property. Now we can either search for that property, 49 High Street in Eltham, or we can just chuck that TradeMe link in there, and it's going to start pulling through a lot of the details. Like, it's already going to tell us that it's a house. We just need to tell Opes Plus that it's an investment. We're obviously looking to buy it, and it's an existing property. Now, one of the things Opes Plus has done is it's already gone to Velocity, which is a property valuation company, and estimated the value at $295,000. Just watch out for that though, because this property is looking for inquiries of $359,000 or more, but maybe that price is too high. The next thing we've got to do is figure out what is the rent going to be per week. Now, I've already been onto TradeMe to find out what are other similar properties renting for in Eltham. Now, there aren't too many properties currently renting in Eltham that are similar, so I'm going to take my best guess at $450 per week, and we don't already have a tenant. Now, one of the things that's really cool is Opes Plus will assume what some of the costs might be based on the value of the property, like your rates, maintenance, insurance, but you can always turn those off and fiddle around with them. For instance, if you don't have a property manager, well, in that case, we're not going to have any property management fee, but in my case, I'm going to put that back in, and then we can see what the numbers actually look like after we put in the mortgage. Now, we're going to assume that we're going to borrow all of the money to buy this property, and let's say we actually could get it for the $295,000 that Velocity says the property could be worth. And we'll assume that's at 4.4%, or actually interest rates have gone up a little bit since I last updated that, depending on which bank you're with. Let's say you lock it in for a bit longer, and 4.8% is what we're going for. And then what it's going to spit out is a cash flow that is based on some pretty robust numbers. We've thought about the rates, the maintenance, the insurance. We've thought about the interest rate and how big of a mortgage it's going to be. And we can see that in this case, the rent is unlikely to cover all of the costs of owning that property. The property would require a top-up of $42 a week, but over time, we would expect that the rent might increase at a faster rate than some of those costs, and the property might initially be cash flow negative. It requires the top-up, but after a while, after a couple of years, we'd expect that it would tip over and become cash flow positive. And we can even click on that little table icon there to understand some of those costs, like the fact that it's going to take a couple of weeks each year to find a tenant. So we're not going to have $450 a week worth of rent multiplied by the 52 weeks in the year. Similarly, we've got things like property management fees, which are going to go up over time as you increase the rent, or things like your insurance, your rates. These are going to go up in cost over time, as is your maintenance. So we need to factor all of those things in to get that cash flow forecast. Now, of course, we also want to understand that return on investment, and we can click in here and say, okay, based on that property increasing by 5% per year, how much might it go up by over 15 years? $273,000 is the projected number, and that's after adjusting for inflation. Same thing with cash flow. We can see the total returns and the total investment that this property would require. Remember, it's a 30% deposit because it's an existing property, so that's why the equity investment is $92,000 in this case. And then the other thing you can do as a property investor before you go ahead and purchase a property is compare that to maybe some others that you are looking at. You can put them side by side, compare the relative return on investment, the rent, and also stats around how that property could perform in the future. Now, once you get that return on investment number, you'll probably think, well, what's a good number to aim for? This does change a bit depending on the market and how you set up the property, which is why I've written a detailed article that I keep up to date about what sort of return on investment to aim for in today's market whenever you are watching this video. And I'll drop the link for that down in the description. But as a general rule, you want to see an ROI of at least 200% over 15 years if you're using the no cash needed method. And that means for every dollar you put into a property, you're expecting to get at least $2 back, at least in today's money. The link to create your free Opes Plus account is down in the description, and this tool alone is worth thousands of dollars, but you're getting it today completely for free. But just before you go off and start running the numbers on lots of different properties, I once had an investor who owned 2 investment properties that she had owned for around 7 years each. And she said to me, Ed, how do I use these properties to stop working and pay for my retirement? And that is a situation many investors find themselves in. In my experience, too many investors start by thinking about the deal, what property they're going to buy, rather than the destination or about the outcome they actually want from investing in property. Now, if you think about what is the outcome you want from property investment, for most of us, it's the ability to stop working earlier or to have financial freedom, to do what we want and travel where we want, when we want. But to get that financial freedom, we often need to draw an income from our properties. And if that's the destination, we need to start investing with that end in mind, which is where you need a wealth plan that tells you how many properties you need to invest in and how much wealth you need to create to hit those goals that you want. But before you create that plan, you need to know that there are 2 main approaches to drawing an income from your investment properties. The first is the nest egg strategy. That's where you hold on to your properties as they increase in value. You gradually sell them, take out that money, invest it, and then spend that money up until you die. The only problem with that as a retirement strategy, you can't predict when you're exactly going to die. So you either work too long or you live too long and run out of money, and neither of those is ideal. And then you've got the golden goose. This is where you own your properties with not too much debt on them, and you just live off the rental income from those properties. You never actually sell down your properties. Yeah, you might change them up, move from growth to yield properties eventually, but in this strategy, you don't spend your capital. You live off the rental return. Now, this strategy does have some downsides. It's more expensive. You need more assets to make it happen, but your money is less likely to run out over the long term, and you need to know which strategy you're going to aim for, the nest egg or the golden goose, so you can create that wealth plan, because that is the first question you're going to be asked in My Wealth Plan. Now, this is another free tool available in Opes Plus, and you can use it to create your own wealth plan and see if you're on track for the retirement or the financial future that you want. And again, up until recently, you had to book a meeting with one of my financial advisors to get access to this, but now it's in your hands. Here's how it works. So the first step to creating your wealth plan is come into Opes Plus, go to My Wealth Plans, and then click Create a Wealth Plan. Now we've got to give it a little name. Let's call it Ed's Wealth Plan, and we can jump straight into it. Now these are the 2 different strategies that we just discussed, the nest egg and the golden goose. I'm going to go for the nest egg strategy today, and let's say that I want to spend not $100,000 per year, but let's call it $1,500 per week is what I want to do when I am retired. And we can see that it automatically adjusts the goal on the right-hand side. I'm currently 33 years old. I've already chucked in some details ahead. My wife, Angela, actually, she's just changed her name. Angela McKnight, she's 29. We're going to kick off this plan spending $1,500 a week of today's money when I'm 65. And it's going to end when I am 90. Now, we can start adding in things like my KiwiSaver. So let's say that my KiwiSaver is 50 grand a year. I earn $100,000 a year, and I'm currently contributing 4% to my KiwiSaver while my employer's doing 3%, and I'm in an aggressive fund. Now, when we add in that KiwiSaver, we can see that even though it's only $50,000 today, which is a pretty good KiwiSaver, that's above average, over time, it's expected to grow by a lot and fund quite a significant portion of my retirement. Let's pop in Angela's KiwiSaver as well. Let's say hers is 30 grand, she's earning 60 grand a year, and it's 3% matched. And let's pretend she's in a growth fund. We can see how that KiwiSaver really might contribute and grow over the years. But let's say we don't have any investments, and we're going to say in this case that we don't think that we're going to get the New Zealand superannuation, or we've got a lot of uncertainty about that because we're really young and that program might change over time. Well, the calculator shows us that we want to live on $1,500 a week, but actually, based on what we're currently doing, we might only get to $891 a week in this scenario. And if we wanted to live on that $1,500 a week, we're going to need to build about another $704,000 worth of assets over the next 32 years in order to get us to that point. And that's where you might decide to start investing in property. Now, I've already filled out a few details, and when you do that, you can click up here and see that actually, based on my numbers at the moment, I'll be able to spend a lot of money on investment properties because I've got a bit of equity in my house right now. Or we can add in a property. Let's say it's a Christchurch growth property. It's going to cost $600,000 and we're going to use the no cash needed method. We're going to buy it this year and we're going to say it goes up by 5% per year. And when we add that in, we can see that that could potentially add a lot of wealth to our portfolio because we're looking at an asset that's quite expensive, a $600,000 asset that's going to go up in value over 32 years. So it makes quite the contribution. Now, because of that, you might decide that actually we can maybe afford to retire a little bit early and click down here to see what would happen if you did that. Now, you do need to be a little bit careful with this because let's say I decide to retire in 28 years. Neither me or Angela will be 65, and so we won't have access to our KiwiSavers yet. And so you do want to think about some of those rules and regulations. That can be a little bit difficult, which is why you might decide to get your plan reviewed by a financial advisor who are across all of those details. And what's incredible about this tool is it gives you confidence. You can see, if I invest in property, am I likely to get in the right ballpark for my financial goals? And you could run different scenarios and ask yourself, well, what if I buy in Auckland versus in Invercargill? And what if I buy one property now but another in 5 years? And what if I decide to retire at 60 rather than 65? It's not just about running numbers on individual properties, it's about understanding how they fit into your wider strategy for your financial freedom. And there are two ways you can use this tool. The first is to take the DIY approach. You use the calculator yourself, you run some different scenarios. The second thing is, once you've done that, you might get it checked by a financial advisor from Opes partners, where you can either review the plan you've created or you can work with them to create a new plan for you. And I'll drop a link for you to book a free session down in the description with one of my team. But there is another big step you need to take if you're going to invest in property. Over the last 40 to 50 minutes, you've gained the knowledge and the tools to take your first steps in property investment. But you also need to know that knowledge alone is not enough to get financial freedom. And I often put it to investors this way. How smart is a university professor? How much knowledge do they have? Probably heaps. They're incredibly intelligent. They've got more brains than me, 5 brains out of 5. But if you talk to people who are professors or lecturers at universities, while they have a lot of knowledge, they are not always the most financially successful. Compare that to my podcast co-host, Andrew Nicol. He's a property investor who didn't go to university, and he won't have as much book smart knowledge about property as, say, a university professor who specializes in property, but because he's used the knowledge that he does have to actually invest, he's incredibly financially successful. And I use this example not to talk down about university professors, but to show you that knowledge alone isn't enough for financial freedom. You've got to do something with the knowledge you have to get ahead. So it's good that you've now gained more knowledge about property and property investment, but that knowledge alone won't help you get ahead unless you do something with it and actually invest. And previously, I think our generation was told that the key to financial success was go to school, gain knowledge, get an education, and all of that is true. All of that helps, but the missing piece is doing something with that knowledge. Adding action is what makes the difference. And that's where there are two paths forward to investing. You could either go it alone and take everything you've learned in this video, find a property online and start investing on your own. For some of you, you're going to do that. You're going to be very financially successful this way. And that's where you find that right deal online, find a property accountant, learn how to do due diligence on a property, find a lawyer, find a property manager. And it's kind of like building a DIY toolbox. There's a second path that often property investors don't think about, which is to work with a financial advisor or a coach who can say, don't go down that road, I've been down it, that way is not going to work. And my company, Opes Partners, is one financial advisor that you could use, but we're not the only ones. There are others you can find online. And if you do choose to work with a financial advisor, it's less of a DIY toolbox and more of a Swiss Army knife, where you get all of the tools you need in one package. That includes preferred lawyers, a property team, checklists and properties to invest in, and free tools like I've shown you today, maybe even some property managers and mortgage advisors, all in a way that's simple and streamlined. And if you want to book in a free meeting with one of my financial advisors, I'll drop a link down in the description. But even if you choose to go it alone, now you know whether you can afford an investment property, the 3 critical decisions you need to make, where to buy investment properties in New Zealand, and how to run the numbers like a professional investor, and of course, how to build a $100,000 passive income plan. The most important thing now is the action though. Don't let this just be another video that you watch on YouTube and forget about. Take at least one step today. Use that affordability calculator to find out how much you could borrow, or take the investment assessment to find out which strategy could be right for you. Use the area analyzer to get free data for over 1,000 suburbs in New Zealand, or use Opes Plus to run the numbers on any property, or even create your own passive income plan in My Wealth Plan. All the links are down in the description, but remember, knowledge is powerful, but knowledge plus action changes lives.